Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. Today we're going to go through Twitter, see what people are sharing on social media. I'll interject my financial opinions related to three different topics: wealth building, commodities, and/or financial topics. So we're going to dive right in, take a look, see what's going on today. If you want to follow me, it's at @Finance. And if you want to join our community, findingvalue.com, where I dive deeper into all these topics and sectors, looking for investment opportunities and sharing those opportunities with everyone in the community. You can join using that coupon code SPECIAL. You get 50% off the first month only on monthly uh, a monthly program or sign up. The yearly membership, you get a larger discount. So you can always swap from a monthly to a yearly if that's what you'd like to do, and get a larger discount. So Tim Hack, it says, Peter Brandt, that is. Peter, please stop following me as soon as possible. Your understanding of history is disgusting. You're simply coping with the fact that you're wrong about the silver breakout the entire time. As he's saying, silver is just a junk industrial metal pretending to be precious. If you bet silver eventually follows gold a la 78, 1980, gold was leading, silver was going to follow, and he's coming out with silver's just a junk industrial metal pretending to be precious. My opinion, let's throw it in there. Why not? It doesn't matter. I don't care what Tim thinks. I don't care what Peter thinks. I don't even care what James Anderson thinks about silver. You know why? Because it doesn't matter. It doesn't matter. Does the chart look good for silver to go up under? Yes, it looks good. Is it undervalued? Yes, it's undervalued. That's all I need to know. All of this is just theatrical garbage. Blah, 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 back and forth doesn't matter. So look at history, look at the conditions that silver has done well under. And if you believe that those same conditions are coming in the future, which I do, which is an increasing interest rate environment that's inflationary, I think silver's going to do well. It is that simple. Can someone persuade me differently? No, I don't think so. There isn't much that someone can do or say to tell me otherwise. Why? Because you just have to look at history, which he's saying, and say, are we going to have an increasing interest rate environment? Now, you could also look at the supply demand of silver, and is it getting tighter or looser? I would say the supply demand between the two is tighter. We're running deficits. And eventually, things are going to come about where prices have to go higher to incentivize more production. Now, demand, I think, will go up with time as interest rates go up, as there is a factor there of people not wanting to own bonds. And I think that will impact both gold, silver, platinum, and palladium, and other metals like copper, even. They'll say, well, copper's not a monetary metal. It doesn't have to be. It just has to be an alternative to bonds, and it has to be a store of value. That's all it has to be. Oil, too. Oil as well. And you'll see countries start to stockpile iron ore and copper and oil and other things that keep its value. It's really that simple, guys. And then disconnect from the world. It's like if these conditions exist, you buy it when it's cheap and you just sit and you wait. And then people start, they start yelling at each other here. Okay, whatever. Doesn't matter. Platinum, the top performing commodity in the first half of 2025. Did I know that? No, I didn't know that. You know what I did know? I know it was one of the cheapest asset classes in the world when it was down, and it's still probably one of the cheapest asset classes in the world. Do I know it's going to outperform in the second half of 2025? I have no idea. Do I need to know? No, doesn't matter. A lot of the times you get these big outperformance run up impulse moves. It could consolidate, it could run higher. Tough to say which one it is. Now, everyone's going to say, well, you use the technicals. Use the technicals to find exactly what it is. No, if it's undervalued, it's undervalued. I would stay long in it. And there's other things that are occurring in the background, which maybe it gets worse. in the very short term, maybe gets better. Now, some people say, well, Andy, you're not taking a stance on it. You don't have to if something's cheap. You buy it when it's cheap, you sit in it, and you wait for it to be overvalued at some point in the future. You just be patient here. I thought this chart was interesting. So this is revenue per worker has never been higher. This is productivity by dollar to worker coming back. Now, check this out. Right here in 1990, this is wave one, wave two. It even has the pattern that I look for. Wave three, wave four, and then wave five, and then the consolidation of a three hump consolidation. Now we've broken out of that three hump consolidation to the upside. This isn't productivity by dollars to worker coming back. And it has the same type of chart pattern that I see in price charts all over the markets. I just thought that was interesting. I mean, it's in everything. These, I'll call it the herd psychology being transcribed into a chart of revenue per worker. That's insane. All right, so coming down. A debt-free company can't go bankrupt. That's correct, says Peter Lynch, which is true. Ramp Capital says millennials are so much better at parenting than boomers ever were. It's honestly embarrassing how wide the gap is. I don't know if that's the case, is it? I mean, can someone come out and say that? Um, I think there are things that were better back when so my parents are baby boomers and I'm a millennial and obviously I'm a parent too. And I don't know what's better and what's worse. I think things are just different. Uh, I would go out and play when I was a younger kid, 9, 10, 11, 12. I would go biking all day and I wouldn't see my parents that often throughout the day. There were times where I had problems and I had to figure those problems out on my own. So I think that that technology, the lack of technology at that time was beneficial to myself of growing up quicker. Technology has allowed kids to call parents whenever they have a problem. So they're a lot more dependent, I would say, and a lot less capable of solving their own problems. So I think the independence and the inability for people to communicate as easily back in the 80s and 90s were beneficial to the kids. That's my opinion. So is that better parenting? No, that's just part of the time. And I don't know how you'd even measure this necessarily, but I think the nutrients were better back then than they are today in food. Um, so there's, I think, other factors and iPads didn't exist or any of that stuff, which I think kids develop problems from. So there's that. Peter Lynch says wonderful companies become risky investments when people overpay for them. What does that mean? What does overpay mean? Does that mean that you're paying too much for the price to book, price to earnings? That's probably a combination of all those things. In commodity companies, how would you evaluate the valuation of the company? Their price to earnings varies dramatically as their earnings fall during the commodity price fall, and then their earnings are cheap, price to earnings ratio, when the commodity price goes up. So how do you know what the fair value is when the commodity price can shift so dramatically from year to year to year? Um, I think commodities are a little bit different than companies that control the selling price of their products. I think it's a little bit easier with that. And I think that's why a lot of people avoid commodities in general, is because of the large volatility in the commodity price itself, which impacts all the financial metrics of a company, like the fair value of it, perhaps. But what I've seen is that if you're in the right conditions, market conditions, that is, you want to buy commodities when they're cheap and equities and just hold on to them through the commodity bull market. That's what I would do. Charlie Munger on strong interest. He says, in my whole life, I've never been good at something I wasn't very interested in. It just doesn't work. There's no substitute for strong interest, says Charlie. And that's, I think that's really important. When I grew up and I go and I look back at what I did just for fun, and what I did for fun, I can tell you it's just biking around when I was a kid. So I just would bike everywhere. I mean, I would literally bike. I would climb things like trees and climb whatever. Um, I also would go hit baseballs for fun. So I'd go to the park and me and like a couple other kids, we just hit baseballs all day. And when you grow up, obviously I played baseball, I played hockey. I'd shoot hockey pucks all day too, and stick handle in the um, just at like regular parks because they would freeze. We would have ice rinks outside in Minnesota in the winter, and they would just freeze water outside, and then you could just go ice skate all day every day. So that's what I did. And then when I grew up, dramatic shift, and I did stuff that I wasn't necessarily as interested in. It wasn't like I'd just go pick something up and go do it. So I think that was a big disconnect for me. Was I probably got involved in work that maybe I wasn't as interested in. There was parts of it that I was interested in, but um, engineering isn't really engineering. It's more of just like paperwork BS and pencil whipping crap. I mean, that's really what it kind of turns into. And then when you do it for a little while, it gets pretty boring. Terry Lynch. So let's read this one. It says mining stocks are so mispriced right now, it's almost comedic. But that disconnect, it won't last. Here's why, in his opinion. He says not long ago, mining made up 5% of global capital allocations. Today, it's closer to 1%. Meanwhile, demand for critical minerals have never been higher. The gap is both the problem and the opportunity, which I agree. Okay, okay. So what happened? Capital chased tech multiples, passive flows, and liquidity. Mining has seen a slow, messy, outdated. But here's the thing. You can't build EVs, data centers, and grid infrastructure without what we pull out of the ground. Completely agree there. Governments are finally waking up. Canada's in, the US is in. Even President Trump is back on the mic talking about critical minerals. That tells you where the puck is going. The money is starting to come back quietly for now. But when it does, it won't be a trickle. It'll be a flood into a very small set of companies with actual assets, real discoveries, and the ability to scale. That's why we're looking to move to the New York Stock Exchange, because to play the big leagues, you need to be where the serious capital lives, where there is optionality and not just visibility. But we're not waiting for the market to figure it out. We're building our own re-rate, top-tier discoveries, fully funded drilling, smart science, not hype. If you believe capital flows where value is being built, you'll understand exactly where this is headed. This sector is trading at 30 cents to the dollar, which won't last. This is your chance to buy the dip before the re-rate in a few months. I don't know if it's in months, but yeah, I think the whole sector is going to get re-rated. I think that the decline in interest rates, that 40-year decline in interest rates, pushed a bunch of capital into financial assets as well. And I think that's all going to unwind. I think we're going to see an unwinding of financial assets and the valuations that are being that are being put on those financial assets will come down, and money's going to rotate into hard assets. But that doesn't mean that they can't go up both together in a very inflationary environment. I just think that hard assets will outperform. A question for Bitcoin bears out there from Jesse Day. He says, what would it take for you to reconsider your stance? If the year is 2030 and Bitcoin is $1 million a coin, or are you still screaming that it's a Ponzi scheme 2040 and it's $5 million a coin? All the way to your grave, no matter what, I'm genuinely curious. My question back to Jesse is this. I said, I think a better question would be, if the price of Bitcoin did not appreciate at all, why would someone buy Bitcoin? So take price out of it. And if you listen to all of these people, Raoul Pal, if you listen to Michael Saylor, listen to their arguments. Their argument is Bitcoin's the best performing asset. Bitcoin's the best performing asset. Bitcoin's the best performing asset. Okay, dude, I get it. It's gone up a lot. Why is it so good? Bitcoin's the best performing asset. Okay, why is Bitcoin an asset? And sure, it's gone up the most, but why is it so good? Why are people going to stay there? If everyone's buying Bitcoin because the price is going up, and in this question up here, it's embedded in the question. What would it take for you to reconsider your stance? If the year is 2030 and Bitcoin is $1 million a coin, are you still screaming that it's a Ponzi scheme? They're justifying the investment because the price went up. So rather than taking the price and justifying it by price, my question is then, if the price of Bitcoin did not appreciate at all, why would someone buy Bitcoin? And I don't know the answer to that, and that's why I don't buy it. I don't buy it because I don't know why anyone would buy it outside of them trying to price justify it. If the price didn't go up, why do we need Bitcoin? We don't. Problem solved. Like that's the way that I view it. The average rent has gone up by 217% over the last 2 decades, from 759 to 1650. If that rate of increase stays the same, then in 30 years, the average rent will be $3,000. In 75 years, it will be $5,000. In 153 years, the average rent will be $8,500. One day, affordable rent will be $5,000 a month. When I look at this and I view, I know that rent goes up 759 to 1650 in 2 decades. Okay, so let's just say, hypothetically speaking, that every 2 decades it doubles. So if I buy and I want to live in a house and I don't want to move, and I'm in a certain location that I want to stay in, I would be a buyer because I can lock in my costs at today's costs, even though it may be around, if it was 2 decades ago, around 759. Everyone at that time is going to tell you $759. It's so much better to rent because $759 is cheaper than $900 mortgage. And I would say, no, I'd rather have the $900 mortgage and then the ability to refinance in the future, to lock in my costs today, and maybe even have the option potentially to refinance and make my costs even lower in the future, which you can't do with rent. So I don't view a house as an investment. I view a house as a way to lock in my costs. So if this is history, why wouldn't I lock in my costs? And you can always have the option to refinance if interest rates were to go down. That's the way I view it. Peter Lynch, every economic recovery since World War II has been preceded by a stock market rally. And these rallies often start when conditions are grim. Can you use the news to buy the beginning of the rally? No, you can't. Because the conditions are grim and people will be talking about how bad it is. That's the beginning. That's the bottom. When all the bad news is priced in and everyone's still telling you it's crap, that's when you buy. U.S. frac spreads fall 6, tap new cycle low, down 24% year over year. Look at the U.S. frac spread count. That is down from 2022. Are we in a bear market? Yep. Has it bottomed? Not yet. Now, the market will bottom before this bottoms. This is backward-looking news. The market is projecting forward. And if all of the worst news is priced in, that is the bottom. Is that the exact bottom? I don't know. Depends what the market is pricing in and how bad their projections are, which no one knows because everyone's different. Learn this early. A man who is a master of patience is a master of everything else, says good old George. Here's one. It says the secret is there is no secret. Consistency over intensity. Progress over perfection. Fundamentals over fads. Over and over again. Rock 4 says silver squeeze is on. Yes, the silver short squeeze appears real. SLV shares available to short are at 0. Borrow fees are rising 2.75%, and the short interest is high at 44 million shares amid supply deficits and solar demand. Current price, 38 bucks an ounce, likely to reach 50 plus short term. Historical patterns suggest 200 plus is possible in 4 years if momentum holds, though 500 is highly speculative. I gotcha. Sounds interesting from Grok there. You like that? I don't know. Rashad says gold is trading at the apex of a 3.5 month triangle formation. There it is, the apex. There's not much room left, and resolution is imminent and most likely to happen already next week. The coming breakout targets $3,900 gold price, which is over 16% from the present price level. The most recent 18.5% rally, or $545 in gold, during April of 2025, which is also the base of the present triangle formation, took only 2 weeks. I would not be surprised if gold traded near $4,000 already by mid-August. That's crazy if we get to that height that quickly, but we could get a breakout. You can see that squeezing. Generally, you get a squeeze before another impulse move higher. It looks pretty good. Chinese equities are on the verge of completing a textbook bearish to bullish reversal. There's your iShares MSCI China ETF looking like it's breaking out. That looks pretty solid there. Pretty solid. Here's Grady talking about gold. Said in the link post below 14 months ago, this very simple chart will play out. Doubting this will be the biggest mistake of your lifetime. In a resumed bull market, there's always a next resistance until there's not. This red parabola line fits perfectly, and the time frame makes complete sense for a move like this. The first gold bull market phase, the second, and then we're entering the third final phase. The breakout of the cup and handle here, and then the subsequent big move in gold's monster breakout here. Sam Getling says the next leg of commodity super cycle has started. Wait, he's admitting the super cycle. Wave 1, wave 2, and here we are going into the next wave of that super cycle. Are you ready for this? This is commodities excluding gold. And we're seeing a lot of stuff turn up here. Fertilizers, rare earth metals, lithium, all sorts of stuff. Those are generally inflation-sensitive assets. They are not, they don't trade with gold. Gold goes first, and then the inflation kind of works its way through the system. But they can run together, where gold goes up and commodities start to take off too. And I think that's where we're at. That's sure what it seems like. The London Platinum lease rate spiked to 29%. Market may already be broken, says David Jensen. Well, that's interesting. Good thing I bought a bunch of platinum when no one was looking. Now, all of a sudden, we'll see what happens. This could get real interesting here. LBMA platinum lease rates jumps to 29%. This is insanity. We are officially beginning to see the world scrounge for resources. What a time to be alive. London Platinum gets tight. There it is. Price plus 6% in 1 week. There we are, ripping. That's the 1 month lease rate in the green. And then price is in the blue. And then you can see in April, that's back when the tariff crap was going on. And that's the Trump's U.S. trade tariff exempt bullion. But here we are, ripping. Just absolutely ripping. Bruce blown away by climbing platinum lease rates. So what does Bruce say? He says, I've been in precious metals market in 39 years, and I've never seen this high lease rates. There seems to be a serious shortage of platinum in local Zurich and London accounts. Supply-demand deficit were fueled by Chinese import from these accounts and also shipment to the CME warehouses. And the worst news is that China bans exports of platinum, even if they don't need that much. Lots of businesses will have to face serious damage with this crazy lease rates. And that lease rate, that's the impact that it's having. Interesting. Don't get frightened out at the wrong time. The time to get rich is by buying when share prices are low. It seems so obvious, but share prices are low when people are the most frightened. And that's where we're going to end it. That's what I've got for today. So give me a thumb up for the content. Subscribe to the channel. Subscribe to the website. That's all I've got for today. So we'll catch you next time. This is Finding Value.